Welcome back to Trading Hour on CNBC-TV18. And on a word for the markets now, Nilesh Shetty of Quantum Advisors is joining us to talk more about market fundamentals. Nilesh, good morning. Thank you so much for joining in. A word on the markets first up. It's been a little choppy after the budget, but a word on the broader markets more importantly. Is it time now that investors who have made plenty of profits should take some money off the table?
Yeah, generally, when we look at valuations across the board, it is very difficult to find value, barring select pockets, say barring private sector banks or some select financials. Uh, it's almost like resembling the markets that we saw in 2006-7, where getting value was not easy. Valuations were expensive and getting more expensive. And to assume double-digit returns, which is what bare minimum that we expect from equities, from current levels look tough. So unless there's a time correction or price correction, it looks like it is set up to deliver under par returns from equities. So yes, people who have made excess money or are allocated more than what they should be over long term can take some money. But generally, investors need to be careful at these levels. At least our advice to our investors has been that if you have 100 to invest, perhaps you should allocate a small portion of that right now. And if the market gives you more opportunity, you allocate more. But investors need to be careful at current levels.
Nilesh, as Zomato continues to show its execution prowess quarter after quarter and expanding its profit margins at a time when its peers, the QSRs, are struggling, is it time to rethink on Zomato? What is your view on the stock?
Yeah, I will not be able to comment on stocks, but generally platform companies, see, there is a reporting profitability and there is trying to justify valuations of the companies. So moving from loss making to profit making is one thing, and then to justify market cap and what kind of cash flows that you need to generate is very far off for these companies. You have to make fairly optimistic projections in their entire basket to justify the valuations, where they have to substantially improve profitability and cash flows to make some kind of sense on valuations. So we've not had any allocation to that basket. They came close probably a year ago, where some of them sort of made sense for us. But they had to correct a bit more from those levels, which they did not. They bounced back. But we've not allocated to any of the players in that entire space.
Interesting thoughts there, Nilesh. PSUs, another pocket that has surged, and now it is seeing a bit of pressure. How much of a dip is too much of a dip to classify it as a dip, Nilesh? And do you find any pocket within that PSU space that is offering value? Since you said that finding value right now is extremely difficult, is there a pocket there? PSU, banks, defense, is there a pocket like that?
No, even sort of we are scratching our heads in terms of what is going on in the entire basket. So we had allocation to that space, and these are the names that we added probably 5 years ago, where they were deep in value. But generally, these are companies which are inefficient, very poorly run, and corporate governance is an issue, capital allocation is an issue. So when they go from a level where they are deeply undervalued to some sense of decent valuation is fine. But most of them now look overstretched in terms of valuations. They are not on par with private sector peers at all. So we've actually trimmed our position over the last sort of 6 to 8 months across in the PSU space in terms of names that we've had. We still have some allocation there, but for me to justify any of the valuation in that market would be tough. I think investors need to be really careful in terms of what is happening in that space.
Nilesh, short conversation, but we got a little bit out of it at least. Thank you very much for joining in. We're out of time completely on the show, Trading Hour. Thank you for watching.